In today's video, I'm going to talk about the Federal Reserve's interest rate reduction. I'm going to explain to you what the Federal Reserve is and how these interest rates impact the way you spend money. Stay tuned. It's been an interesting few weeks to say the least. Coronavirus has grown into an official pandemic. Restaurants, schools, and other businesses have closed their doors. And the Dow Jones has fallen nearly 10,000 points from its recent high. In addition to all of that, the Federal Reserve lowered its interest rates by an astonishing 1% in an unprecedented fashion. I'm an advocate for having a personal emergency fund saved in a high-yield savings account. If you did the same, you might have noticed an email from your bank informing you that the savings rate was cut by 1%, meaning that your savings is no longer keeping up with inflation. Some of you might be wondering what the big deal is about lowering interest rates by 1%. How can something as small as a 1% adjustment have such a huge ripple effect? Adjusting the interest rate tends to have substantial effects on Wall Street and Main Street alike. Since discovering I have a blog and a YouTube channel where I talk about personal finance, people have asked me to explain what all these changes to the status quo mean for them. I've discussed how the Dow's 8,000 point drops impacts investors previously. I'll leave a card above this video if you'd like to see that. I'd like to explain how the Fed's rate cut impacts the average American. Make sure to maximize your impact on the channel by clicking the like button for the algorithm. I'd really appreciate it. Your likes help the channel to grow and allow more people to learn how to grow their wealth. If you're new to the channel, hit the subscribe button below to improve your outlook on money and your life. Tune in, take action, and take charge of your finances. I'd first like to talk about what the Fed is. I know many in my audience already understand this term. I like to approach writing as though every video is someone's first. Please bear with me while I explain this for people who are new to finance. The Federal Reserve System's About page tells us that they are the central bank of the United States. Though the Federal Reserve performs 5 functions in order to support the United States economy, there is one major function that we need to be concerned about in this video. That function states that the Federal Reserve promotes the stability of the financial system and seeks to minimize and contain systemic risk through active monitoring and engagement in the US and abroad. The Fed has a number of tools at its disposal to accomplish this. One of those tools is the Federal Open Market Committee, which oversees open market operations like buying or selling securities, such as treasury notes or mortgage-backed securities, to its member banks. This allows the Fed to simply sell securities to banks when it wants to raise interest rates in an attempt to slow inflation and stabilize economic growth. Conversely, this also allows the Fed to buy securities when it wants to lower interest rates with the goal of lowering unemployment and stimulating economic growth. Now that we've discussed what the Federal Reserve is and what it does, it can allow us to understand exactly why it took the unprecedented actions it took on Sunday. The Fed lowered interest rates as a response to the coronavirus pandemic, slowing down many businesses in the United States to a halt. This was done in order to make money cheaper for businesses to borrow, so that they can afford to continue to produce goods and services, as well as keep people employed. This turn of events isn't just good for businesses, though. The Fed's rate cut might just help keep a few more dollars in your pockets as well. There are 3 ways the Fed's rate cut can help the average American. Credit card interest rates are associated with the rates that banks charge consumers with the best credit. This is known as the prime rate. That prime rate is usually about 3 percentage points higher than the federal funds rate determined by the Fed. For example, the average credit card debt in America is about $6,028, with the average interest rate being 19.02% for new offers and 15.1% for existing accounts. Assuming your debt is on the existing account and you're only making the minimum monthly payment of $185, you'll pay $1,779 in interest over 42 months. However, with the Fed lowering interest rates by 1%, making all of the same assumptions, you'll wind up paying $1,617 in interest, saving $162 over the life of the debt. Student loan interest rates are also affected by the Fed's rate cut, but not in the way you might hope. Student loan interest rates are set for life at the time of the borrower requests a loan, so the Federal Reserve's rate cut won't affect pre-existing student loan debt. However, this means that students looking to borrow money to attend school in the near future may have the best possible opportunity to borrow money for college at record low rates. The yield on a 10-year Treasury bond is associated with student loan interest rates. If the yield on a 10-year Treasury bond went down to 0, undergrads can borrow money at a rate of 2.05%, and grad students can borrow money at 3.6%. The yield on a 10-year Treasury bond as of this writing is 1.228% after falling to a record low of 0.318% earlier this month. Interest rates for the 2020 to 2021 academic year should be decided at or around May 12th. So as long as the yield on a 10-year Treasury bond is less than 2.48%, its yield on May 12, 2019, rates on federal student loans will be lower for the coming academic year. I've said it in previous videos, but it cannot be overstated. The Federal Reserve's interest rate cut will most affect people's mortgages. Like student loan rates, mortgage interest rates are loosely connected to the yield rate of a 10-year Treasury bond. This may help make it more affordable for first-time home buyers to buy a house. It also makes refinancing existing mortgages more attractive. A year ago, the average rate for a 30-year mortgage was 4.31%. A week ago, it was 3.77%. Today, the average fixed rate for a 30-year mortgage is 3.88%. For example, the average house in the United States in 2019 was $315,000 according to Dave Ramsey. Assuming this number is accurate, the buyer was able to get a rate of 4.31% and the buyer put no money down, the monthly payment would be $1,561 a month. Making all the same assumptions but using today's average fixed rate of 3.88%, the monthly payment would be $1,482, saving the homeowner $79 a month. The Federal Reserve, or the Fed, is a central bank of the United States and can directly lower and raise interest rates in the country. They may lower rates at a time when businesses are struggling to make it easier for companies to stay in business and keep people employed. The Fed recently lowered rates by 1%. While this made saving money in the bank less attractive, it will save the average American hundreds of dollars by making money cheaper to borrow. This means that they can spend less money when repaying their credit cards, repaying student loan debt, and paying a mortgage. Well, that's my videos on 3 ways the Fed saved your job and your money. I appreciate you watching. Let me know any questions, comments, or topic suggestions you might have on personal finance in the comments below. Be sure to support us on all of our social media platforms. Follow us on YouTube and now on Facebook at Smart Money. Links will be in the description. If you're watching on YouTube, subscribe and hit the notification bell to be the first to know when I come out with new content. Make sure you like the video for the algorithm and be sure to share that video with a friend. Click the links in the description for offer information. Lastly, if you want to get started investing in the stock market and are looking for free stock, Robinhood is holding a promotion in the description. Use the link to start your Robinhood account and claim your free stock shares. Comment below and let me know what you get. Thanks for watching, and I'll see you in the next video.